Hi, Tom Lydon here in Chicago at the Morningstar ETF Conference here with Ben Johnson, head of Global ETF Research for Morningstar. Ben, great conference.
Thanks so much for being here, Tom. We're thrilled to have you again.
Well, it was great. I mean, the industry is just on cloud nine. We hit record levels. There's new money coming in this year. I mean, what would you say some of the highlights of the conference have been?
Well, it's crazy. I mean, you look back now, we've been doing this 7 years. This is our 8th annual conference. And over that time, ETFs have gone from sort of a fringe element, right? Like an inhabitant of the land of misfit toys, to being very mainstream. We've gone from about $800 billion worth of assets in ETFs to now in excess of $3 trillion. ETFs have made it. So I think a lot of the questions on investors' minds are less specific to what are these newfangled things, what does these ETFs stand for, is this some sort of derivative, to wow, these are really great, these are very cost efficient, stable, transparent building blocks that I can use to deliver great outcomes for my clients. So the conversation shifted more from sort of structure and trading to theory and portfolio construction, and what does this all mean when rubber meets road and advisors and individuals go about using these funds to build sensible portfolios.
Is it all driven by fees? I mean, all we hear about is fees, and they get less and less and less. Is that the number one driver of the flows that we're seeing?
I would say it's a combination of two key factors. On the one hand, it is definitely fees. So what we've seen, if you look back over the course of the past 3 years or so, just within the ETF space, the overwhelming majority of assets have flowed into ETFs that charge a fee of 20 basis points or less. Now this resonates with the trends that we're seeing in the industry at large, that investors are flocking to low fee funds of all stripes, be they ETFs, index mutual funds, or even lower cost share classes of actively managed mutual funds. Investors are firmly focused on fees. Now the other key factor at play here is one that relates to just investment performance. The cat's out of the bag. Active management is an awfully difficult game. We've measured this in our Morningstar Active Passive Barometer. What you see very clearly is that over long periods of time, active managers have a very hard time doing anything better, delivering anything more than just a randomly selected average passively managed peer. And the fee signal comes out of that data as well. So what we see is that active managers that are in the lowest cost quartile, the cheapest active funds out there, have better than average odds of success in terms of beating those benchmarks. So the signal is active is hard, fees are immensely important. Investors are focused on fees, and that's what's been driving flows.
So there's been a lot of managers who've been around for decades who are now just finally entering the space, and they can't go for pure beta strategies because that population is already full, right? So they have to set themselves apart by offering factor or multi-factor strategies, but it's been really tough to beat the cap-weighted indexes. Might we see a point in time where some of these intelligent beta, strategic beta strategies actually start to outperform cap-weighted strategies, and especially as investors and advisors are somewhat concerned that this bull market in stocks might be a little bit long in the tooth, shifting a little bit over there might be responsible?
So the short answer to your question, Tom, is maybe. So all of these various strategies are, for all intents and purposes, active strategies. So what we can expect over a long period of time as we see more and more of these come to the market is that the outcomes that they'll deliver, the experience that investors have with them, is not going to be in any way dissimilar to what they've had with active managers. They're going to experience periods of time where they will underperform a broad cap-weighted index. They'll see periods of time where they outperform a broad cap-weighted index. Nobody knows in advance which of these strategies is necessarily smart. We know for a fact that they're not going to look and feel smart depending on where we are in terms of those peaks and valleys, and that cyclicality is going to lend itself to less than smart use of these strategies on investors' behalf, no different than what we've seen in the way that they buy and sell actively managed funds. You see this yawning, in some cases, gap between the returns that the funds produce and the returns that investors actually experience through their buying and selling behavior.
Yeah.
So the more we can try to focus the conversation on controlling for behavior, incremental to controlling fees, I think the better investors' chances are of using these new funds in a responsible manner.
Exactly. So controlling behavior and getting back to the word smart, it'll be interesting to see now with $3 trillion in assets in ETFs, when we do eventually have that correction, are those advisors, are those investors going to be smart and not make the wrong moves?
Absolutely not would be my short answer there. Market downturns are inevitable. The additional inevitability is that people will panic and people will sell, whether they own ETFs, whether they own mutual funds, whether they own individual stocks. You cannot firmly control for investor behavior at large. So while there are a lot of worries about what might happen in that next market downturn, given all the growth that we've seen in ETFs, much of which has happened in the context of a market that just continues to march up into the right, what I would say is that history doesn't repeat itself, but it often rhymes. We've seen countless instances of this in past bear markets. ETFs are a new wrapper. Human nature is by no means new.
Morningstar needs to offer advisors yoga classes. Ben, as
Transcendental meditation, maybe, Tom.
As always, great seeing you and really enjoyed it here.
Thanks for being here.